Good morning, everyone. My name is Pedro Pinto, and I'm the head of MiFIR for AFME. AFME and AFAMA are very happy to welcome you today for this joint webinar on navigating the peer review, a seminar with the European buy and sell sides. This is the first part of a series of educational webinars organizing by AFAMA and AFME that aim at providing policy officers across EU institutions with an overview of key elements of EU capital markets regulatory framework. Today, we'll be talking about MiFIR market structure and transparency across equities and fixed income markets. Part 2 of this series on the consolidated tape and market data will take place in just 2 weeks on the 31st of March. On the agenda, today we'll start with a brief update on fixed income market structure and transparency led by Victoria Webster, who heads our fixed income division at AFME, followed by an equally brief update on equity markets led by my colleague Sean Barwick from AFME's Equities division. After these initial helpful updates, Susan Yavari from AFAMA will lead the Q&A session with AFME and AFAMA experts. We'll also take the Q&A session to address your questions, so make sure that you let us know any questions you may have in advance. We have a very good lineup of speakers today. Representing AFME membership, you'll be able to hear from Elisa Menardo and Claudia Gonzalez. Elisa is Director for Public Affairs and Policy at Credit Suisse, and she's also the chair of AFME's MiFID Steering Committee. And Claudia Gonzalez is Executive Director in the Office of Regulatory Affairs at JP Morgan. She's also the co-chairs of AFME's Fixed Income Policy and Trading Committee. Representing AFAMA's membership, you will certainly enjoy hearing from Dermot Dunphy and Christopher Hawke. Dermot is head of EMEA Equities Trading at M&G, and Christoph is the head of the multi-asset trading at Union Investments. Just some housekeeping before we start with what really matters. If you are here today with us, it's because you really care about capital markets in Europe, and more specifically, because you are interested in the review of MiFIR. To ensure that you make the best of your time, let me just encourage you to raise questions at any point during the event by posting your question on the Q&A tool on your web browser or on your app. We'll make sure to respond as soon as possible during the event or in the course of the Q&A session at the back of the event. Finally, please note that we'll be recording today's seminar and we will share the slides with all the participants after the event. And with this, let's start with fixed income markets with my colleague Victoria Webster. We'll run you through key elements of the bond market structure and transparency. Without any further ado, let me hand over to you, Vicky. The floor is yours.
Thank you very much indeed, Pedro. We have a short animation to show everybody. 2 seconds should be coming up.
As Europe recovers from the COVID-19 pandemic, deep and liquid capital markets are more important than ever for providing necessary support to Europe's economy. Investment banks are market makers that provide liquidity in capital markets. But what exactly do they do? Market makers continuously provide prices at which a security can be bought or sold. This ensures that investors, such as pension funds or asset managers, can find a buyer or a seller when they need one. In bond markets, this role is particularly important. Bond markets are different to equity markets. As a result, bonds typically change hands less frequently than shares do. By quoting prices, market makers in bonds keep the buying and selling process in the secondary markets moving. Having smoothly functioning liquid markets is important not only for investors to change the investments in their portfolios when they want to, it's also important for businesses and governments needing to raise funds. Investors are also less likely to provide finance in the first place by buying newly issued bonds if they think they might struggle to sell these bonds at a later stage. The role of banks differs from that of trading venues, which don't take on any risk, but rather provide a venue for trading to take place by bringing together existing buying and selling interests. Without market makers providing prices, far fewer trades would happen and there would be much less liquidity in the market. This would reduce the amount of funding available to companies and governments. Committing to buy or sell bonds in this way means that banks take on risk. For instance, if they buy a bond, they're exposed to the risk that its price drops before they can find another buyer. Banks are by far the main market participants providing this service, and as such are major partners in facilitating corporate and government financing in the markets. As committed liquidity providers, banks are also key to helping launch new products for which markets still need to be built up, such as green and social bonds. These innovative products contribute to society as a whole by enhancing environmental and social welfare. We need market makers to help ensure vibrant and liquid markets can help to boost the economic recovery and finance our future investment needs. Learn more about AFME's work in fixed income markets at afme.eu. AFME, the voice of European capital markets.
Good morning, everybody. I am Victoria Webster, and I lead AFME's fixed income trading boards, as well as the fixed income MiFID policy and market structure working groups. So I hope you enjoyed our animation, which very much helps set the scene for the first part of this presentation today. Over the next few minutes, I'll be looking at the fixed income market structure. We'll start with the very basics of what bonds are. We'll look at the investors who trade them. We'll look at the different features of bonds compared to equities, and we'll examine the role of market makers in keeping everything moving. And then I'll take you through a very high-level view of the role that MiFIR transparency is playing in the bond markets. Let's go back to the beginning. If we move on to this slide, what exactly is a bond? Well, firstly, as we heard from our animation, bonds play a critical role in providing funding for companies and governments. In fact, governments raise most of their funding through bonds, and this can include different areas of governments, such as local authorities. There's a lot of variety between bonds. A bond will generally have a coupon payment, but these payments can have a fixed or a floating interest rate. They also have different payment dates as well, and they can have very different maturity dates. These dates can range from over 1 year out to 50 years, and a company or a government will usually choose or determine the features of a bond which will match their funding needs at the time. In terms of pricing, bonds are priced as a percentage of what's called par, and par just means 100. There is a yield associated with a bond, and that is the measure most frequently used to determine a bond's expected return. And when that is plotted over the life of a bond on a graph, it provides a yield curve. And the yield has an inverse relationship to price. So when we see yields increase in a bond, price will decrease. Now, hopefully you're getting the sense that there's a lot of variety between bonds, and because of this, they will tend to have different liquidity profiles. So some bonds will be more liquid than others. In short, this simply means that some bonds are traded more, so they're being bought and sold much more frequently than other bonds. So if you look at the markets at the moment, a 10-year German Bund is very, very liquid, but a Slovakian or a Greek government bond will be less so, and that's partly due to the much smaller amount of sovereign debt that's issued. Corporate bonds also, after an active period of issuance, and that active period can typically last just a number of weeks, the buying and the selling activity will generally decline, and then it will plateau until that instrument matures. So the diversity in bond issuance will also attract a large range of different investors. If we move on to the next slide. Thank you. So the vast majority of European bond market investors are institutions, such as asset managers who are acting on behalf of clients, but also insurers, pension funds, as well as retail investors, hedge funds. So looking more closely at these institutional investors to understand their needs from the bond market. So asset managers, they aim to grow the savings and investments of individual clients, and they'll do that by investing a wide range of securities. Pension funds, so probably one of the funds we're most familiar with, given that they're the ones managing our pensions. And as such, they focus on long-term investment in mostly long-term fixed income instruments that offer a targeted yield, targeted return over a period of time. Now, some pension funds have tended to use more of a buy and hold strategy, which is a long-term, what we call passive strategy, and it keeps a relatively stable portfolio over time, and that's regardless of any short-term fluctuations. Insurers is another area of investors. So these are insuring both individuals and corporations against big risk events. Due to the long-term liability, issuers are large investors in the fixed income markets. So whilst the proportion of issuer funds is set aside so that firms can respond quickly to urgent claims, the majority of issuer reserves remain invested in predominantly low-risk, long-term fixed income instruments, and often in the form of government bonds. So by making this investment, the insurance company is able to offset claim costs and maintain lower premiums for people taking out insurance. Now, hedge funds are another active investor, but hedge fund strategies are generally complex. They're more aggressive, they're higher risk as well in order to generate higher returns. The hedge funds will usually trade quite frequently and often in pretty large sizes. We also have retail investment as well, but in the EU fixed income markets, the rate of direct participation is relatively low. And that's in stark contrast to the equity markets, where direct retail participation is pretty high. If we move on to the next slide. So this slide shows the small retail investment on the left in debt securities in the EU. And if you compare that with a chart on the right, where we're looking at approximately 44% of assets are held in bond for insurance companies, and about 46% across all debt markets for pension funds. And of course, in recent years, central banks also become large purchasers in the bond market. They act as an alternative source of liquidity. The European Central Bank, for example, interjected in the fixed income market with the launch of their PEP, their Pandemic Emergency Purchase Programme of 1.8 trillion. And this ensured low borrowing costs and increased banks' lending capacities to support companies and governments and in accessing the funds that they need to operate. So I think it's fair to say many people are generally more familiar with equities than fixed income, mostly due to their experiences. Most of us will be familiar with ISAs and the stock indices, so S&P 500, FTSE 100, NASDAQ, Dow Jones. But what are the actual differences between bonds and equities and how they're traded? If we move on to the next slide. Firstly, let's look at issuance. So I described earlier how the bond market is very diverse, and this heterogeneity of maturities, interest rates, and yields all means that a company will often opt to issue more debt securities than undertake the cost and complexity of issuing shares. So if we take an example, Orange, which was France Telecom, that counts 55 bond issues compared to only 3 equity issues in the market. Now, this naturally results in the demand for a particular bond being lower, as investors, in this example anyway, have 55 bonds to choose from. making each bond a little bit more illiquid and potentially harder to trade compared to the equity. So when this is compared to equities, where there is generally one type of instrument to be traded, and therefore it will trade relatively frequently, the number of actual bonds traded per issuer is often significantly lower. But the average size or average volume of a bond trade will be much higher than on the equity side, and both this and my previous point about the number of bond trades can be seen on the next slide if we move to. Very much. So on the left-hand side, we have the number of bond trades compared to the number of equity trades across a number of operations there. And then on the right-hand side, you can see the average value. So in green, we have the value of bonds that are being traded compared to the value of equities. Now, whilst electronic trading has been happening in the equities markets on exchange for many years, the bond market has been slower traditionally to adopt. Bonds electronic trading really started to pick up in the early 2000s. Now, if we roll forward to now, and electronic or e-trading as it's called, it's a very much an important and well-established part of the fixed income landscape. Maybe we can move to the next slide, Claire. Thank you. So, however, the more illiquid a bond, the less frequently it will trade compared to other bonds, and the less easier it is therefore to trade electronically. And the same goes for a large size trade. The next difference I wanted to make is around the nature of trading. So equities markets are order driven. So there is effectively an order book where all the buyers and sellers display the prices and sizes at which they wish to buy or sell in a particular share. The biggest advantage of an order-driven market system is transparency. It clearly shows the total and depth of the whole order book. But there is no guarantee that these orders will actually be executed. But bond markets will tend to be quote-driven. A quote-driven, also known as a price-driven market, only displays the bids and offers for a bond from market makers. These market makers will post the bid and ask price that they are willing to accept at the time. And we'll look at the role that market makers undertake in a few minutes. But let's look at how trading actually happens in the bond market. So you recall how I mentioned bonds can differ widely from each other. Well, those characteristics can also determine how a bond is traded. If it's liquid, it's not considered a large trade and it requires a quick execution, then it's most likely to be traded electronically via a trading platform. And there are a number of ways that clients can initiate trades with their dealers on these platforms. So request for quote, or RFQ, has been the traditional method for the buy side to trade smaller tickets. So when a buy side trader sends a request to quote to a selected number of dealers, the price received is deemed executable for a short space of time. And then once both parties have agreed, the trade is then confirmed. Usually, on average, 3 to 5 dealers can be asked to provide a quote at the same time. Now, the number of dealers to which a request for quote can be sent depends on the sensitivity of the trade, sensitivity being its potential to impact the market, and to try and avoid information getting into the market before that trade has happened. Now, given the stated differences between fixed income and equity markets, fixed income has remained a predominantly request for quote market. It's very much a quote-driven market. But to avoid the chance of missing a pool of liquidity by not sending an RFQ to the right provider, there is also a protocol called RFQ to all. And that's where, rather than reaching out to just a set number of market makers, you can send it to an unlimited amount. So this remains based on the buy side sending requests for quotes, but it reaches all liquidity providers available on a venue and increases the likelihood of finding the best price trade. There's also all-to-all protocols, and this sits as an additional protocol alongside dealer-to-client market maker via RFQs. And this enables the buy side to also offer liquidity, specifically in corporate bonds. This all-to-all protocol is actually gaining traction as a way to source latent liquidity. However, it's important to note that this price making will tend to be one-sided, so either a bid or an offer, or a buy or a sell, depending on the position that they want to trade out of or into. And pretty infrequent as well. So unlike market makers who constantly offer two-way pricing throughout the day. Also, in times of stress when markets are less liquid, investors are likely to be one-directional in their trading. Now, although all-to-all currently only accounts for a small proportion of trades, it is growing in popularity. As an aside, it's important to note here that government bond structure is different, and there's therefore very little need for all-to-all functionality, despite having some very illiquid bonds. And this is due to the primary dealer network, where each sovereign issuer has appointed several primary dealers or market makers in primary markets. And those primary dealers undertake obligations to provide pricing within agreed spreads. And then there's clear transparency around who is a primary dealer, so institutional investors can know who they can contact to provide a quote. And finally, we have a trade process called a process trade. It's a bit of a hybrid solution, and it's negotiated bilaterally via voice or instant chats. It can be quite significant in size, but it does benefit from being executed on venue, meaning that the reporting obligations are captured and detailed, and the data is in an audit trail. Each trade generates data points, and these can be used to form an overview of the fixed income market landscape and to conduct further in-depth analysis. Now, moving on to the next slide, let's look more at the role of bond market makers. So to recap on our animation, so a market maker is a committed liquidity provider. They dedicate pricing sheets, providing balance sheet, to providing pricing and immediacy of execution throughout the day. This means that investors are able to buy or sell when they need to, even when the other side of the trade is not immediately available. So given the different characteristics of bonds, the possibility of an equal and opposite simultaneous trading interest existing in the market when you want to trade is relatively low. And the availability of quotes from market makers ready to step in to fill this gap is therefore particularly important. The use of risk capital is specific to market making firms because they have the balance sheet and appetite to assume and manage risk. But having taken on a risk trade, the market maker then uses its distribution network to try and find another side of the trade until a market maker is able to find that buyer or a seller, depending on the direction of the trade. It will take the debt into its inventory and will be exposed to market risk. That market risk is changes in the asset's price during this time. So any difference in price between the original trade and the unwind, so the time they get out of that position, presents an inventory risk that needs to be managed. So for instance, in order to protect the market maker from any adverse price movements, it may seek to hedge or offset its position, for which it will incur a cost. Now, one point just to note is that a market maker is also classed as a systematic internalizer, an SI, which is a term that was introduced by MiFIR II, if it has met specific criteria, trading criteria, or has opted in. But its role in providing bond liquidity on a principal basis, i.e. using its own inventory, is the same. Now let's move to the next slide where we look at trading venues. Now, it's very important to note that market makers and trading venues undertake very different roles. Whilst the official term trading venues was used in MiFIR, electronic trading platforms have been around for a long time before MiFID. For bonds, the main trading venues under MiFID are multilateral trading facilities, MTFs. So you're probably familiar with the name a few: Bloomberg, TradeWeb, Market Access are just some examples. And they bring together the multiple buying and selling interests in order to execute trades. There's also OTFs, Organized Trading Facilities, and they do a similar role, but they actually have some discretion in the method of execution. And these were previously known as interdealer brokers. But trading venues, either of them, do not take on any risk. They do not hold any bond inventory. They instead provide a platform and functionality to facilitate trading interests for which there is usually a cost involved. So a trading venue does obviously offer a good choice to investors. We looked at the protocol earlier and the different choices on how they request the pricing and executed trades. So what's actually happening to the information when a trade is executed? If we go to the next slide. So MiFID is one of the largest pieces of financial regulation in terms of transparency globally. It requires details of all trades executed by a MiFID investment firm to be reported and published publicly. Currently, trades are reported within 5 minutes of execution, although the public availability is some 15 minutes later. But some trades are able to be delayed or deferred from public publication for an extended time frame beyond this. And the extent of the reporting framework can be seen on the next slide. So you can see that whether a trade is executed either on a trading venue or an SI, so SI was the market maker, or executed via voice from a dealer to client perspective, they are all reported, they're all post-trade reported. And this clearly generates a huge amount of trading data. So theoretically, since the introduction of MiFID II, market participants have been able to collect more post-trade data and use the information to determine the next trade. However, it hasn't quite worked out like that because the publicly available data, post-trade data, is rather fragmented. It sits across a number of APAs and trading venues, and these are institutions who collect and publish this data. But along with this fragmentation is a lack of standardization of the way and the format the information is displayed. So you could have different file types. You can have a CSV file, you can have an Excel file or a text file. And this makes the data rather difficult to access. There are also instances of some data being reported inaccurately. They could have some incorrect bond classifications. So addressing this fragmentation and lack of standardization will definitely help improve the accuracy of data. If you move on to the next slide. So deferrals, I mentioned that not all trades are required to be publicly available within 15 minutes, and deferrals are allowed in certain circumstances. So a deferral is permission from the relevant national competent authority to exceed the standard publication timing requirements, either where a bond trade is above a specific size threshold or if it's classed as illiquid. And these deferrals exist to minimize any adverse impacts on the market by limiting any unnecessary identification of sensitive inventory information, which allows committed liquidity providers enough time to hedge or unwind their positions. A bond dealer needs first to hedge their position and then unwind it generally. As noted earlier, the unwinding phase is specific to bond markets and can take longer to execute than in equities markets. It can result in a dealer being exposed to a greater level of risk, potentially then impacting liquidity. So it's very important that deferrals allow enough time for the risk of a trade to be managed. And then if we move on to the final slide. Move on to the next slide, please. Oh, sorry, apologies. Thank you. Sorry, I referred earlier to the fragmentation of data that exists. Now, there's a lot of talk, a post-trade consolidated tape for bonds will be introduced. And this is going to be aimed at aggregating the current post-trade transparency data for bonds. It's going to provide a starting point to improve the access to the existing fragmented transparency across those trading venues and APAs. Now, because there is a trade-off between transparency and liquidity, so it's good to make bonds transparent, but going back to the point I made about market makers needing time to be able to offset their trades, if they don't have enough time, they might be a little more reluctant to quote next time, or they might build that risk into the prices. So the more liquid a bond is, the more it can withstand real-time transparency disclosure. So once consolidated, this trade data can then be analysed, and then from that analysis, we can identify which bonds might actually be able to benefit from some greater transparency, so very much more liquid benchmark bonds, or some bonds that may need slightly less because it takes market makers a number of days to manage the risk of that particular trade. So a consolidated tape is very good in providing a single picture or an access point across EU markets, and particularly helpful for smaller investment firms and possibly retail investors to get a true picture across the EU bond market. And also international investors, they will be able to have a comprehensive picture of the European market for bonds and help to attract international capital. Now, we'll look at the bond consolidated tape in our next webinar, scheduled at the end of this month. This has been a rather condensed run through of the fixed income markets, but many of these topics will be picked up and discussed by the panel later on this morning. So I hope you found it an interesting overview, and I'll now pass you back to Pedro for the next part of our webinar.
Thank you, Vicky. You are absolutely right. Although fixed income markets are very complex, I would say that you managed to make it simple, what is normally difficult to understand. I hope that that was also helpful for the audience. If any questions, however, are emerging, please do not hesitate to raise your question through the Q&A tool that you should see on the right-hand side of your screen. Just click on Q&A and type your questions rather sooner than later. We promise to respond as soon as possible. And with this, let's move to equity markets and to my colleague Sean, who will run you through key elements of the equity market structure and transparency. Sean, without any further ado, let me hand over to you. The floor is yours.
Thank you, Pedro, and hello, everyone. My name is Sean Barwick. I work within the equities trading team at AFME, and as Pedro just alluded to, in this section, I'll be taking a high-level look at European equities market structure and the transparency framework that underpins it. Before I do so, I just want to make a quick apology. Spring is certainly coming, and we have an unexpectedly sunny day here, and so apologies if the lighting looks somewhat odd. I promise you I'm not sat in a dark room or anything. Just lots of sunlight beaming in. There's certainly a lot to run through, but let's just jump into the first slide if we can. So, as Vicky alluded to earlier, it can be slightly easier to have a feel for equities markets, but I'd like to just very quickly take it back to the basics and point out that when we talk about equity markets, we're talking about the trading of shares. And when we talk about shares, we mean the units of equity ownership in a company. These can be traded on primary markets, which is the exchange where a company is first listed, or on alternative execution venues, and I'll speak in some more detail on those alternative execution venues a little bit later on. And then there's a further question, I think, in terms of kind of getting the basics right, and that's who trades shares. And much like we saw in fixed income markets, there are several categories of market participants which are active in equities markets. And on the slide here, this is by no means an exhaustive list. But some common categories that we see are retail investors, so individuals wishing to invest in shares through a retail broker, pension funds, so those longer-term investors seeking targeted yields over a longer period of time, asset managers, so those who aim to grow the savings or investments of individual clients by investing in a wide variety of securities, or another example would be hedge funds, who generally take a kind of a complex or more aggressive, perhaps more higher risk strategy in order to generate higher returns. If we could just move to the next slide, please. So the next question would be, I think, where can shares be traded? Now, the rules and framework for equities market structure are set by a piece of regulation called MiFID II, as Vicky mentioned earlier. And MiFID II defines the three different types of venue where you can execute a trade for shares. At the top here, we have regulated markets, or in another term, also they can be known as exchanges. Examples of these would be Deutsche Börse, Euronext, or Nasdaq, and these are the kind of the classic examples when you think of a stereotypical stock exchange. Another type of execution venue is a multilateral trading facility, or sometimes referred to as an MTF. And these are the alternative venues which, like regulated markets, can offer kind of various different modes of multilateral trading. And examples of these would be, for example, Cboe Europe or Aquis Europe, which both run MTFs within the EU. Worth pointing out that collectively, regulated markets and MTFs are referred to as trading venues in general, and so it's kind of a term we can use to group the two together. And that's because they have a commonality in that they facilitate multilateral trading on their platforms, which match buyers and sellers anonymously. And then there is at the bottom here a final execution venue set out within the MiFIR framework, and that is systematic internalizers. These are typically operated by banks or electronic liquidity providers and provide bilateral execution services. And I'm going to come on to that in a moment. But before then, I just want to take a minute to touch upon the role played by banks or brokers in equities markets. So if we could just move to the next slide, please. So trading in equities typically takes place through a bank or a broker, which acts as an intermediary between investors and the execution venues where those shares can be traded. Shares in the same company can be traded on multiple different execution venues, which means that banks and brokers have the job of determining the best method of executing client orders to ensure that their client gets an optimal outcome. There are many factors that would come into play when thinking about how and where to execute your client's order. But I mean, two examples just to give you a flavour would be size, so noting that different execution venues offer preferable conditions for the execution of large orders, for example, and that typically might not be on a primary exchange. Another factor might be time. So if there's a need to execute a trade immediately, the most liquid execution venue, where there's the most orders coming into that trading venue, might be the best place to execute for the sake of achieving speed of execution. And that might be the case for smaller sized orders, for example. If we can move to the next slide. So taking a look a little closer at trading venues, the multilateral trading venues that I've put on this slide, I just wanted to touch upon what role they have to play within equity markets. And the key thing that they do is bring together buyers and sellers of shares by providing that matching mechanism. This is demonstrated in a very basic form by the graphic at the bottom of this slide, which shows that both a buyer and seller can meet on an exchange via their respective brokers. So just to kind of put that in your mind and explain that in very basic terms. With this model, the exchange doesn't take on any risk and instead provides a commercial service, and that they earn a fee revenue while they do so, and that's by acting as that multilateral facility where you have the buyer and seller meeting. It's also worth noting that exchanges are sometimes referred to as lit venues, as orders placed on an exchange's order book can be seen by all market participants. If we move to the next slide, we'll touch upon systematic internalizers. So what are systematic internalizers, I suppose, or SIs as we often call them? Here it's important to note that in addition to acting as brokers, banks can also operate as execution venues, as known as SIs, as I just mentioned. MiFIR II defines these as an investment firm which on an organised, frequent, systemic and substantial basis deals on own account when executing client orders outside of a regulated market, an MTF, an OTF, if we're talking about non-equities, without operating a multilateral system. In real terms, more practical terms to understand, the point to note here is that an SI uses its own capital and balance sheet to facilitate more efficient and better priced bilateral execution for its clients. And in turn, this ultimately benefits end investors such as pensioners and savers who entrust their money to the SI's clients, which would be kind of the asset or portfolio managers, for example, to obtain the best possible results for that end investor. And again, I've included a very basic graphic there at the bottom of that slide, which demonstrates the bilateral nature of that SI model. Yeah, we can jump ahead to the next slide now, thank you. So with an understanding then of what SIs and trading venues do at a very high level, I wanted to just emphasize the points on how they differ and leave you with that. There's SIs fundamentally, SIs are fundamentally different from trading venues as they utilize their own capital to trade with their clients, and in doing so, they take on a kind of a bespoke facilitation role. By comparison, trading venues do not facilitate trades using their own balance sheets, and instead they bring buyers and sellers together by providing a matching mechanism, which I mentioned earlier. The point to remember here is that exchanges and other types of trading venues charge a fee for providing that multilateral facility, and SIs, by contrast, earn a profit by putting their own capital at risk. So just to emphasize that clear differentiation in terms of how they operate. Next slide, please. So with this knowledge, when thinking about trading venues and SIs, it's worth then contemplating how much trading takes place across those different types of execution venue. Now, in May 2021, Auxera conducted a study into the landscape of European equity trading, which touched on this exact topic. And their analysis showed that 83% of traded volumes were executed on trading venues, so those regulated markets and MTS, and just 11% was executed on systematic internalizers. Now, what this shows us is that trading venues account for the overwhelming majority of executed trades, while systematic internalizers represent a small but complementary section of the market. And I hope that just gives a bit of a context of kind of the size of trading across different execution venues. We could move then to the next slide. So then I'd like to move on to transparency, and I want to briefly cover the two types of transparency reporting that exist in the context of equities markets, and those are pre-trade transparency and post-trade transparency. Pre-trade transparency refers to the publication of the best bids to buy a share and the best offers to sell a share, which are sent to an execution venue. And pre-trade transparency also means providing the depth of trade interest at those quotes that are being advertised through the trading venues or the execution venues systems. This information has to be made public on a continuous basis during all normal trading hours. And it's also worth noting that systematic internalizers adhere to pre-trade transparency requirements for bid and offer sizes that are comparable to those typically executed on exchanges, known as standard market size, or sometimes referred to as SMS. The minimum quoting size for systematic internalizer is 10% of SMS, and that's the current requirement. We could go to the next slide, please. So related to pre-trade transparency is a mechanism that was built within MiFID II called the double volume cap. Trading venues are able to utilize waivers called the reference price waiver or a negotiated trade waiver in order to provide matching systems which don't publish pre-trade quotes. These are sometimes known as non-displayed or dark trading venues. Trading on these systems is limited by the double volume cap, which specifies that trading on an individual non-displayed trading venue cannot exceed 4% of overall traded volumes, or that trading on all non-displayed venues does not exceed 8% of total trading in that given share. In short, although there are clear advantages to allowing investors to execute certain categories of trades without providing pre-trade transparency, there are strict limits on how much of this activity can take place. If we move to the next slide, please. Worth pointing out that restrictions also exist in the context of the tick size regime. you'll probably be wondering what's a tick size. A tick size is the minimum price increment of a share in which bids to buy and offers to sell can be quoted. MiFID II places restrictions on those minimum increments in which trading venues and SIs can quote bid and offers. Importantly here, through the application of the tick size regime, trading venues and systematic internalizers are restricted from executing trades in the middle of the bid and offer prices for a given share, and that price is often known as the midpoint. So that middle price in between a bid and an offer. This restriction currently applies to trades that are below large in scale, and what that means is trades that are not large by comparison to the average size of a trade in a given share. So we move to the next slide. As I mentioned earlier, the other type of transparency reporting that takes place is in the form of post-trade reports. This refers to the publication of size, price, and the time of the execution of a trade. These reports must take place as close to real time as technically possible, or in any case within 1 minute of execution. And all execution venues, by which I mean both trading venues, so regulated markets and MTFs, as well as systematic internalizers, are subject to these post-trade transparency obligations. I've just underlined this last point at the bottom to emphasize a point, but important to emphasize that this includes non-displayed and dark trading venues, or flash dark trading venues, I should say, who are waived from pre-trade transparency requirements, but have to provide full trade, post-trade transparency. Just a important note there. We can move to the next slide. We may have. Oh, sorry. So sorry, apologise. Just here, I wanted to just mention, kind of provide a view on what transparency requirements are applied across different types of execution venue, and you can see that the pre and post-trade requirements are applied in every circumstance, except for where those non-displayed trading venues do not have to provide pre-trade transparency. And then in the context of midpoint, when you look at that column on the right, we just see that there is a restriction that says that midpoint execution is only available above trades that are larger in scale. If we could then move forward. So for my final slide, I just wanted to take a look at take a forward look and consider the changes that have been set out within the Commission's MiFIR review proposals, which were published in November last year. In the context of equities market structure and transparency, there are a few proposals that are significant. Firstly, a proposal that the minimum trade size at which systematic internalizers are required to provide a pre-trade quote will go up, and that will go up from 10% of standard market size to 200% of standard market size. And for context, standard market size is around 10,000 euros, around that mark, meaning that SIs have to provide publicly tradable quotes, or will have to provide publicly tradable quotes at a value of 20,000 euros when the previous requirement was just 1,000. So that's a significant leap upwards. Secondly, the Commission has put forward a proposal which would introduce a new complex system which determines whether systematic internalizers can match trades at the midpoint in different trade sizes. So beneath 200% of SMS, which is that 20,000 euro mark, midpoint execution would be banned. Between 200% of SMS and large in scale, which is around 600,000 euros, midpoint would be permissible if it's possible to do it on a whole tick or a round tick, which won't necessarily always be the case. And then above large in scale and above that 600,000 euro threshold, there'll be no restrictions. Additionally, there's the use of the reference price waiver by non-displayed trading venues will be restricted to above 200% of standard market size. and currently there's no restriction whatsoever on the kind of the use of that reference price waiver when it comes to size. And then finally, the Commission has proposed that the double volume cap becomes a single volume cap that restricts non-displayed trading to 7% of overall trading. So I think that covers the key components of the EU's equity markets when it comes to looking at the market structure and transparency elements, and also, I suppose, where these might be headed in the future. Hopefully I've been able to explain it clearly enough, although it's certainly not simple, and I don't doubt that some questions might have occurred. Thankfully, we have an excellent panel coming up, and I'm sure they'll be happy to discuss any questions. And I'd be very happy now to pass over to colleagues who will take us on to the next section.
Thank you, Sean. Again, an extremely clear update this time on equity market structure and transparency. Thanks for that. We are running slightly late on our schedule by close to 10 minutes. So let's allow for as much time as possible for the Q&A session with the experts. So that's what really matters. Susan Yavari from EFAMA will lead us through the next phase of this seminar, which promises to be the most interesting part. So enjoy, and do not forget to raise any question you may have in the meantime. Susan, without any further ado, let me hand over the floor to you, and thank you, everyone.
Thank you, Pedro. Thank you, John and Vicky, for very illuminating presentations, which I hope have been well received by our listeners today. As Pedro said, I work at EFAMA, and I'm responsible for capital market regulation. So I think if I look at the two presentations we had this morning, there's quite a lot to unpack, but hopefully these are concepts that we'll return to in this panel that we're planning for the second half, and we'll have sort of a bit more ease to move back and forth from some of these elements that were introduced. But from my end, I think it was very important to understand the different trading dynamics that pertain to each asset class. So very important to distinguish equities from bonds, and also to have an understanding of the role of trade size and also the liquidity profile of the instruments that we're talking about. And of course, the topic we'll come back to is, again, the market making function of investment firms and the provision of liquidity. The other thing which I think was quite useful, and again, I hope well received by listeners, was this overview of trading venues, understanding what trading venues were introduced as a result of MiFID, and how, again, depending on the trade that you're looking to execute, how one or another venue will be most suitable. Also, I think looking at the diversity of trading venues, we understand that they provide us with choice, protection from price impact, which is something we'll go into, and then potential for price improvement, which is this midpoint price matching. And I think as Sean sort of was concluding his presentation, he kind of led us nicely into what I hope to be the focus of the second half, which is understanding what the EC proposal that is currently on the table entails, how it will impact the market participants that my panel represents, their ability to operate in capital markets, and what some of those exemptions on pre and post trade transparency that we have today, how changing those levels will have an impact on our ability to perform certain tasks. And you know, as Pedro said, we really want this to be an open discussion. You know, we're providing access to experts, so we hope that people feel free to use the chat. But yeah, I think there's concepts that you will typically hear about, and this is really the place to kind of hopefully delve into. But if we talk about dark trading versus lit trading, the price formation process, these are all things that perhaps we should think about getting into and set for ourselves as an ambition. But we are running late, so I would like to ask our four panel members to introduce themselves. And in doing that, I'd like to invite you to just take a little time to explain your personal background, what you do in your firm, and sort of what your day-to-day life looks like, because I think that will add color to, again, to the listeners who want to understand what you're doing and where your viewpoints come from. So a final point before we kind of formally kick off the two panels. For the sake of clarity and ease of listening, we're still going to have sort of mini panels. So we'll talk about equities first, and then we'll talk about changes in the bond market structure second. So with that sort of setup in mind, I'll probably ask Dermot and Elisa, who will lead in the first panel. So Dermot and Elisa to introduce themselves, followed immediately by Christoph and Claudia, and then we'll move to the discussion. So Dermot, can you please introduce yourself? Thank you.
Hello, good morning all. I hope everyone can hear me. I see by the nodding you can. I've had some IT issues this morning, so it's been a struggle to get in. So I work at M&G on the equities dealing desk. I'm the head of the EMEA trading, so that's everything in Europe and Africa. We, on our desk, are responsible for trading everything that is equity related, so that's stocks, futures, options, convertible bonds, and ETFs. We have a desk of 7 in London. We have a desk of 3 in Asia, in Singapore. The desk of 7 in London trades everything in Europe and the Americas. I've been at M&G now for 21 years, so I've seen a lot of changes over my time. I've seen the introduction of MiFID and obviously MiFID 2 and now the MiFIR and all the other relevant regulatory changes. But we look at that on a global basis as well. Asia trading used to be traded in London up until 2 years ago when we set up an Asia desk. So we're very cognizant of the global landscape of trading. At M&G, we manage £370 billion worth of assets. That's for 5.3 million retail customers and 800 institutional clients, and that's across equities, fixed income, real estate, and private equity. My main role, the day-to-day job of the equity dealers here at M&G, we have the portfolio managers, as we just touched on earlier on. They're responsible for allocating capital, and they make decisions as to how they want their portfolio to look. So they will instruct us with a trade, so maybe to buy or sell a stock, and it's up to us then to go and execute that in the market. We are what's commonly known as the buy side. We're buying the service from the brokers, the sell side. So we will take the order and we will decide how we are going to do that, how we're going to interact with the market, and how we're going to execute that. As part of that, we look at all the different options, which we'll get into further on in the discussion here. We are regularly involved in discussions with regulators, with the exchanges, with our peers, and with our industry bodies and industry groups. So I think that's me briefly. I don't want to take too much time.
Elisa, thank you so much, Dermot. Elisa?
Thank you, Susan. Good morning, everybody. So my name is Elisa Menardo. I work in the public policy team at Credit Suisse. For the purpose of today, I'm here representing the sell side, so the broker aspect of Credit Suisse, the bank. The bank is active in equities markets, which is why I'm here on the equities panel. And within Credit Suisse, what I do is essentially be aware of legislation that may be about to change, maybe in 5 years' time, maybe in 2 years' time, and make sure that the business understands what the policymakers want to do, and we work out what the different options might be, what the impacts might be, and then essentially we talk to each other. So I spend my days looking at potential new legislation and talking to everybody who's involved in the markets that would be affected by the legislation on one hand, and all of the people are involved in making decisions around the legislation to make sure all aspects of possible consequences, pros and cons of different options are taken into account. My background, you can probably hear I'm not a native English speaker. I'm Italian. I started off in economics, then moved on to law. I worked in the protection of consumers of financial services at the European Commission way back when, at the beginning of the 2000s when the euro was being introduced. And since then, I've worked as a regulatory lawyer in London, both on the private side in a law firm, then at the regulator, the Financial Services Authority, where we transposed MiFID I. And since then, I've been still working on MiFID. So I think I've now been working on MiFID or its predecessor, the Investment Services Directive, since at least 2001, looking at it from the perspective of a policymaker, from the perspective of a regulator, from the perspective of those who have to implement the new rules, and then those who have to comply with the new rules. And now I'm getting back to the beginning, in that I'm looking at the rules before they are being drafted, with a variety of colleagues from across not just our own bank, but also the industry, because chairing the MiFID steering committee means getting people together from different banks and different parts of banks to look at how MiFID is working currently and how it might work in the future.
Thank you, Elisa. Christoph?
Susan, thank you for having me here this morning. My name is Christoph Hock. I'm running trading at
Christoph, you went on mute briefly.
Can you hear me, Susan? Perfect. Christoph Hock, my name. I'm running trading at Union Investment. We as Union Investment, we are a Frankfurt, Germany-based asset manager. We have about 440 billion euros asset under management, where we have the trustworthy obligation to manage these assets in the very best interest of our retail and institutional investors. We have about 1,400 funds in total across various asset classes, equities, fixed income, multi-asset and real estate, and a very large proportion of these assets, of these funds are UCITS funds, where on behalf of retail investors we try to achieve the very best performance. Looking at our trading desk here, we are a total of 20 traders. We are set up as a central trading desk, meaning we cover here out of Germany all global regions. We cover Asia, we cover Europe, we cover the Americas, and as alluded before, we literally trade all business resulting from investment decisions made by our portfolio managers in cash equities, in fixed income, in FX, in derivatives. Also, sec lending is a decent part of the business we are doing here. When looking at our goal, it's clearly about achieving best-in-class execution for our portfolio managers and therefore indirectly also for our investors, meaning the quality of execution we achieve here at the trading desk feeds directly, has direct impact on the performance of our funds. And therefore, it's important for us looking at the debate about regulation, not only to fulfill best execution when trading, but also to be a sparring partner for you, for the European Commission, for ESMA, for central banks, and for treasury departments to advise when it comes to regulation what potential side effects that this could have on execution quality, and whether there are potential negative implications for our investors. So directly feeding into the performance of our funds. Therefore, as said, many thanks for having the opportunity here to share our thoughts on potential changes coming on MiFID II, and we are very happy to give you humble advice from our perspective, which kind of implications this might have. Thank you.
Thank you, Christoph. Claudia, can we move on to you now?
Sure, I'll make it very short, Susan. And good morning, everyone, and thank you for having me here today. I'm Claudia Gonzalez Cabanillas. I work at JP Morgan. I've been working in the regulatory affairs team for the last 8.5 years. Previously, before that, I used to work at the UK regulator, sitting on a number of ESMA task forces, always been specialized in market issues. I've been working on MiFID for the last 13 years. So I saw implementation of MiFID 1 and then the MiFID 2 review and now, MiFID 2 creation and then now the MiFID 2 review. I work in reg affairs, which means that I look at the pipeline of legislative proposals, what regulators and policymakers are thinking about changing. So I kind of look at that very closely, and then I work together with our business to understand the impact that these can have, not only on our business, but also on the market and on our clients as well. And then very similar to Elisa's job as well. So yes, today here, I mean, JP Morgan, as you know, has a very big presence in Europe. We are a bank which does all type of activities, but today I am here to represent the sell side. That's it. Thank you very much.
Okay, thank you, Claudia. Thank you all four panelists. So I think, as I explained earlier, we'll kick off and sort of delve more into the equity market structure. And I think it might be nice just to give Dermot and Elisa perhaps an opportunity to give you some very high-level thoughts around this MiFIR proposal that we have on the table, which looks at providing consolidated tape, which we'll, as we said, address in a future session, but also introduces significant changes to the transparency framework that we have. So before we sort of go into the whole alphabet soup of large and scale, LIS, SSTI, let's start off easy, and perhaps you can give me just sort of a high-level view of where you feel that this might impact you. Thanks.
Thank you, Susan. Perhaps if I can zoom out for a little bit, we've spent almost an hour going into the detail, and I think it's important that we think why this matters, because it really, really matters. What we're talking about is whether European capital markets will function more or less well after these changes are made. And well-functioning capital markets are fundamental because as Europe tries to recover from the shocks of COVID and hopefully recover from the shocks of the war, we are going to look to have companies that are competitive and that can find funds to grow, to make investments, to become more efficient, to provide good jobs that pay well for people. And crucially, we're also going to be looking for ways in which individuals, people like all of us, people who are listening on this webinar, can invest their savings. Because we all know that if we go to the bank and leave the savings in the bank account, we're actually going to end up buying a lot less in a year's time with that money that we can buy now. So it's essential that we can invest that money in a way that brings us good returns. Because if you've never invested in capital markets, you dip your toe in, you invest, and you find that it's a disaster, you're not going to come back. You're going to try and get a return in another way, which could be either you keep your money under the mattress or you keep it in a bank account and end up with less ability to buy money, or you try and invest in things that are not regulated and maybe you don't even realize they are, and then you have a big problem where things go wrong. So the discussions that we're having now really matter to people and to companies. It's not some abstract thing that happens in a different sphere. It has real life implications. So the changes that we're talking about, are they going to make capital markets more efficient? Are they going to deliver better outcomes for investors? And by the way, let's not forget that investors is all of us. It's not just the specialists like Dermot and Christoph. Dermot and Christoph have mentioned various times they manage people's money. They manage our savings and our investments. So what are we going to have? The Commission is trying to put rules in place that make it more likely that we get a consolidated tape, which we're going to discuss in 2 weeks' time. Consolidated tape is a good idea because it means we can all understand what's going on. We all know at the same time, more or less. And crucially, for the jobs that Claudia and I do, when we talk about what's going on in Europe, we at least all are looking at the same picture. then we can have different views as to how that picture should be looking going forward, but at least we're all looking at the same picture. At the moment, we're not necessarily all looking at the same picture because each person has to bring together the different colors and paste them. And we get things that look more or less the same, but not necessarily so. The consolidated tape, good idea. Then there are the other changes, the ones that for equities Sean had on his last slide. Are they going to make European capital markets more efficient? Unfortunately, no, I don't think so. Talking to the experts, and Dermot will go into the detail, I'm sure, the short summary is that they're probably going to make trading in Europe more complex and more expensive. And the problem with trading becoming more complex and more expensive is that if you are a third country investor, somebody who can invest their money wherever they like in the world, are you going to do it somewhere that costs you a lot of money and that you don't quite understand because the rules are very complex, or are you going to do it somewhere where you get a better deal and it's easier? Doesn't take a rocket scientist to work that one out. If you don't have that choice, what do you do? Well, then you're stuck with higher costs and increased complexity. And we all know that if things are complex, it's easier than they go wrong. And so then again, we end up with suboptimal outcomes. So the discussion we're having really matters. And now for the detail, I pass you over to Dermot.
Thank you very much for that. I think that was a very, very good summary of it all. I think another key point to remember, and touching on this, is that we are owners of the company. We often hear terms of a bet on the stock market, but we're not. As asset managers, we own these companies, and we have a vested interest in the companies being sustainable and being ongoing concerns. And by putting roadblocks in the way of people investing, that can add to the difficulties of this. We're there to advise the companies, to help them with financing, and all of these issues can be roadblocks by excess legislation as such. And the other issues that were pointed on by Elisa there were liquidity. I think that's the main issue. When we want to invest in companies, we want to put our money to work, the ability to do that, if it's hindered or it becomes too expensive, may become a negative, as pointed out earlier on. And I'll leave it there because I know we're running short of time.
Thank you, Dermot and Elisa. So I take note, Elisa, on sort of when you homed in on the MiFIR proposal, you described potentially a trading landscape that's more complex and expensive, and also the impact on third country investors, looking to enter the EU or not. So I think this is perhaps a good moment to pause, and maybe Dermot could take the lead here and really just walk us through, as an asset manager, when you're looking to execute a trade, how does that look? Are you accessing the market through a broker, as we saw in previous slides? We hear about broker algos. What are those? And I think probably most crucial in this discussion is understanding the typical large trade sizes that we bring to the market as asset managers. So how is that large trade broken down? And if you could overlay the time element on this, the speed of execution, which we also heard about previously, if you could sort of walk us through that, I think that would be useful, and perhaps then speak to the complexity that Elisa was referring to and potential costs. Thanks.
Yeah, so we have a whole range of orders here at M&G. They could be small orders, and as referring to Sean's earlier slides, they can be one times SMS, they can be smaller than that, but also majority of the time we'll have large orders, we'll have big orders. It may be something, for example, buying $1 million Total, which is a big lumpy ticket, and that's broken down into, we refer to that as the parent order, so buy 1 million shares, and then it's broken down into child orders, which are segments of that, the bits that we will go out into the market to try and acquire. And when an order comes to us, we'll have a look at it and we'll assess the various ways that we can go and execute that in the market. Essentially, I try and use the analogy that I've got a big rock that I'm throwing into small pond that I'm trying to create as less ripples as possible. I can either break it up into lots of little pieces of gravel and throw them in and make loads of waves, or I could just have one big rock that I throw in, it makes one wave and I disappear and it's gone and the surface is all calm again. So when we're looking at that order, how do we do that? Do we go and try and find the other side straight away and find a seller of 1 million shares? Or do we go to the brokers and access all of their different venues that they can have? Do I go to the dark pools? Do I go to the lit markets? How do I do that? And then thinking about how all of those different venues, the actions and the reactions that occur. Every time I enter the market, I cause a reaction, and I have to be cognizant of that fact. I have to be aware of that fact, and essentially I try to minimize that as much as possible. At the heart of what we're doing is best execution. It's about obtaining the best outcome for our clients, and as referred to, that's the retail investor. That's the person in the street who's entrusted us with their money and their savings to give them hopefully a better return and a better outcome at the end of the day. So we have to weigh up all of these, and best execution is a key point of that. And we spend a lot of time on our best execution. We spend a lot of time reviewing what we've done, how we've done it, and then learning from that. But essentially, I'll go to the market and I work out where I'm going to have the least amount of impact. I can be aggressive or passive. Aggressive means that I'll be out in front of everybody trying to buy as much as possible, but again, as you can imagine, that's sending big signals. That's telling everybody that there's a big buyer in the market, and they will adjust their behavior accordingly. If they say there's a big buyer and they're a seller, they may start to ease off and they won't actually come to market, and they'll try to let me push the price up. So these are all factors that we're looking at when we're trading. And again, liquidity is a key point to that. We touched about the large and scale, we touched about on the SIs. It's about the risk that I'm able to get and how much liquidity I can generate for all of those child orders that create the overall parent order. I hope that's clear enough.
Yeah, it certainly was for me, Dermot. Thank you. So as a counterpart to that, can I ask perhaps Elisa come in and explain to us, we heard sort of bits and pieces of it during the presentation from Sean, but can you explain to us what an SI does? Because are you more than a trading venue? Because you're dealing in your own books and you're taking risk on balance sheet. And so can you explain to us what this capital at risk is and sort of your role as liquidity providers as a counterpart to what Dermot described when he's coming into the market for a trade?
Thank you, Susan. No, we're not a trading venue. We're an execution venue. And it's not just a difference in terms. As you were saying, it's a fundamental difference into what we do. On a trading venue, different people come together with readily formed views as to how much they want to sell or buy and various prices which they're prepared to do it. A bilateral venue, an execution venue, which is what a systematic internalizer is somebody who essentially puts their own money in play. So what happens is Dermot might come to my colleagues who operate it. I say Dermot, in reality it's all computers that do this, but bear with me for the moment, with the humans. He'll come and he'll have views as to what he needs to achieve for his portfolio managers. And those views will not just be related to price. You might want to get a certain amount of shares, as he was saying them. You might not mind how long it takes, as long as other factors are fulfilled. And then he can look at the various options that are on the table. One of the options that he'll look at is trading with a systematic internalizer. Why? Because a systematic internalizer will buy things off Dermot and then hold them on their book. And then hopefully, from the systematic internalizer's point of view, sell them on at a price higher than is bought them from Dermot. That's how the systematic internalizer makes money. But making money that way is, as you can imagine, risky, because while you hold the shares, the price of the shares can go up or go down. I might buy them thinking that lots of people are going to want them, and then something I'm not expecting happens, and nobody wants them anymore, and I have to hold them until I can sell them again. Obviously, banks are regulated entities. There are rules to make sure that banks are stable and don't go bust. They're financial stability rules, which means that we have to manage the risk that we take. And there are very strict limits on how much risk you can take, which basically means in practice, when I buy shares from Dermot and then I hold them on for a while, I can't use the money that's backing that share buying to do something else, cost me money. So I have to be quite careful in the engagements that I make. But from the point of view of the market, and specifically Dermot in particular, what we're doing is acting a bit as a cushion, as a shock absorber, because maybe there isn't on the trading venues enough people who want to sell what is trying to buy. We might have some, we can sell it, and that way we act as an absorption point. But as I was saying, that costs money, and so we need to make sure that we don't take too much risk. And that's why the rules that are coming are going to make life more difficult, because they make it riskier to, for example, put quotes out. When you put out a quote as a systematic internalizer, then you have to stand by that quote. If I say I'm going to sell these shares for 10 cents, and somebody comes and wants to buy that, I have to do what I said I was prepared to do. If the minimum size that I have to do that in is no longer 10% of the standard market size as it is now, but it's 200% of the standard market size, you can see that the risk I'm taking in saying that I'm prepared to buy or sell at a particular price is much higher. And because risk is expensive, as I was saying earlier, it means I need to be more careful.
Thank you, Elisa, for this. So we are running a little late, so I'm going to have to fire the questions at you rather than have our gentle conversation we've been having today. But so I understand, and you made the case why in certain circumstances we need waivers on pre-trade transparency, and we don't have sort of that full view when SIs are coming into the market, and equally on the buy side when we're looking to execute trades. I wonder if you could explain something to me around the price formation process. So does it mean that dark trading, if we call it that dark trading never contributes to price formation? That's I think one question that perhaps people would like to hear about. And the second piece is, do we aim for pre-trade transparency as a goal, or is there this sort of nuance that we have to bring there, that it's not pre-trade transparency at all costs, but there's a more sort of balanced approach that we need to aim for? And if you could build into that the role of the consolidated tape, that would be very useful as well. But if you could give me your views then on sort of price formation process, is dark trading completely removed from that, or is there some kind of process that you could speak to there? And then the second piece is, how far do we want to go with pre-trade transparency? Both Dermot and Elisa.
Yeah, I'll go first on that. So pre-trade transparency, we do see that, and it's really, really helpful. It affects our decision making. It affects, and again, this probably touched on consolidated tape. It is all really, really wrapped up together. When we're looking at the availability of liquidity on the market, that's affecting our decision. How quickly do we progress the order? Do we speed up? Do we slow down? It's kind of a bit akin to driving a car and having a map. You have a map and you go from A to B and you do that. But now you can use your smartphone and you can use a map that's live and real time, and it's showing you actually that road's blocked and you might go another way. And this is what pre-trade is doing us. It's giving us much more information to make our journey for executing an order is A to B, the start of the order, and B, the end of the order, finishing the order. And by giving us more transparency, which is what the consolidated tape will do at the start, we can plan our route. We can actually navigate the markets smoother and more easily with less impact. And we do see transparency on the SIs. The SIs are constantly updating their prices. They're constantly coming to the players. As Elisa said, more and more the orders are executed via a computer. It's not like the old days where you'd see those pictures of a stock exchange and people shouting prices at each other or shouting prices at the phone. It's all electronic now, so it's being the order is being driven by the smart order router of the broker, and that's deciding all of the best venues to go to, and it's collecting all of that information, and then it's choosing where to go. So yeah, that's my summation of it.
Yeah, no. Can I suggest? Yeah, if there's anything else you want to say, because I'm going to need to move to the bond discussion if you don't mind, because we've probably run out of time.
I'll be very quick, Susan.
Anything, yeah, go ahead, Lisa.
I think that the key point that Dermot was making there, and that also picks up on the questions that we have in the Q&A, is why the consolidated tape matters. It matters because it tells you not just if it includes pre-trade, what's about to happen, but also crucially what's just happened. And that's why it's important that it's a fast consolidated tape. In equities, 15 minutes ago is 3 years ago. What you really want to know is what happened a second ago, a minute ago. Yes, of course, when the computers talk with each other, they go much faster, but they are not. It's not just the electronic decision making done by programs, algos, but there's also humans. So a fast tape is really key. But your second point that we haven't touched on is transparency the whole story? Well, no, it isn't. As we were saying earlier, capital markets are about what? They're about allocating resources. You want to end up with a situation where everybody has ended up in the best position they possibly could. For people who've done economics on this call, we're talking about allocative efficiency. If you have a situation in which you don't end up with everybody having got the best option, if you have people who would have traded but don't, and on the other side, there's people who would have bought something had it been available, but they couldn't find it or they couldn't meet, we all have a worse result. And a worse result in capital markets means companies having less money to invest or investors getting a worse deal. So it's really key that we get it right. Yes, transparency is important, but if you pardon the level of the example, is a bit like salt in a dish. You absolutely need it, but it needs to be at the right level. If you have too little or too much, your dish is not going to taste right.
Okay, thanks so much for that, Elisa, and also Dermot. If you don't mind, we'll move to bond market structure now because we are running out of time. So the question I'd like to put to Claudia and to Christoph is, sort of given the discussion we've had now in a rushed manner around equity markets, the issues around executing large orders, avoiding market impact, the search for liquidity, as Elisa was saying, how do these concepts play out in the fixed income world, and are they amplified? And from there, I think we can quickly move on to some of the proposals from the EC, particularly around the deferrals regime. But kick off on that.
I'm happy to kick off, Susan. So yes, I agree. So the story we're looking at is very similar, but I will say to your question, is it amplified? The answer for me will be yes, it is amplified. And the reason why it is amplified is because bond markets generally, we will say, are by nature less liquid. While the equity market is characterized by high participant to instrument ratio, the bond market is mostly characterized by low participant to instrument ratio. So what does that mean? It means that there are usually fewer market participants. Their governments and companies issue many different types of bonds with many different types of maturities and interest rates. And just the trading frequency in bonds is just generally lower, hence why we say they're by nature less liquid market. And so if we compare to the equities market, where we can imagine on an exchange you have lots of buyers and sellers come together and they match. In the fixed income market, it's not always like that. And most of the time, it is a market which is intermediated by liquidity providers, exactly for that reason, because there's not always readily available buyers and sellers in the market. And therefore, liquidity providers play an important role where we provide immediacy of execution to our clients. When our clients, will not be able to find the other side of the trade, we will take on the risk on balance sheet, and then we will need time to get out of those positions. And I won't go into everything that has already been said, but really the nature is the same, but the pace and, generally the nature, the liquidity of the market is less liquid.
Yeah, I think maybe Susan from my side to am I on mute or can you hear me?
We can hear you.
Fine. Vicky has also alluded to the fact when trading fixed income instruments, we as a buy-side firm, we predominantly make use of market makers, of investment banks providing us with prices, trading against the balance sheet, against the risk capital of these investment banks. And looking at a larger trade in the fixed income universe, it takes a broker, it takes an investment bank about 15 to 30 days to recycle this position in the market. And therefore, to keep the ecosystem intact, it's clearly important that on the one hand, the trading books of these market makers, they get protected. So a maximum of transparency in the fixed income world obviously would lead to adverse effects also for us on the buy side, because pricing wouldn't be as aggressive, as attractive anymore as it is right now. And an execution quality which is worse, has immediate impact on the performance of our funds. So therefore, it's really important to understand when we're looking at fixed income markets, dynamics are different from equities. We have hundred thousands of fixed income instruments in the equities world. You have on a global basis about 6,000 instruments. Liquidity, as Claudia was alluding, is completely different. Typically, when a bond is issued, in the first couple of weeks, you have a very high turnover in the market, and then liquidity trading volume is kind of fading out because lots of investors they have buy and hold strategies, whereas in equities you have on an ongoing basis trading activities in the individual stocks, and these different dynamics clearly we have to take into account when looking at regulation, when looking at equities versus fixed income. And it's really key when discussing now about modifications of MiFID II, that we keep this ecosystem intact. So on the one hand, providing a higher level of transparency, but on the other hand, also assuring for the sake of liquidity provision by sell-side firms, by brokers, by investment banks, to have the protection enabling them still to make attractive prices for individual bonds to the buy side.
So that's very useful, Christoph. Perhaps you and Claudia could comment on the actual deferral reform that the EC is looking at, because there's a certain simplification of the deferrals regime that we're looking at, and also a reduction, I think, in certain circumstances. So would you be able to comment and walk us through the proposal that I think is maximum of 2-week deferral, and which instruments you think it's critical to salvage in this ecosystem that you described, Christoph, and that would be damaged if the EC proposal went through as is proposed now?
Claudia, do you want to start? Should I start?
You can kick off.
Okay, more than happy to do so. So fixed income instruments are completely. I mentioned it before. We have hundred thousands of fixed income instruments, and they are different. So a fixed income instrument isn't necessarily equal one to another. You have various what we call sub-asset classes. You have sovereign bonds, so government bonds. You have corporate bonds. You have covered bonds. So one criteria to differentiate is the issuer of the bond. Also, when looking at these sub-asset classes, you have different categories. When taking a French government bond, an OAT, or when taking a German Bund, these instruments typically are highly liquid, so there's huge level of issuance on an ongoing basis. These instruments in normal market circumstances, and they are fairly easy to trade. You have lots of broker firms providing us risk with risk prices. We're looking at some peripheral issuers. Just take Portugal for instance, or even when you take Italy. You have typically, to a lesser extent, tradable liquidity. Similar situation we have in corporate bonds. We have on the one hand the so-called investment grade bonds and highly solid companies. We have on the other hand high yield bonds in times of recession. Typically you call them junk bonds, but the precise definition is high yield, and they are typically characterized by a high level of illiquidity. And looking at these types of liquidity patterns, it's really key that for the less liquid ones, there is no immediate publication of the price and no immediate publication of the volume going through. And what would be the consequence if there's an immediate publication? So probably the whole market would be aware of. I mentioned recycling period with sell-side firms is about 30 days plus for the less liquid stuff. So all market players would be aware that there's one broker sitting on a large chunk of a position. And on the other hand, due to potential publication, maybe this was just the first clip we sold as a buy-side firm. There's more to follow. There would be an awareness of the market. There's high activity going through.
I hate to be so rude, but we're actually going to be cut off by the system in exactly 1 minute. So I'm very glad you brought to light the liquidity picture and why immediate price publication for certain types of instruments is absolutely a non-starter and would harm the market. I'm afraid, Claudia, we won't have time to come to you, but I think it's a testament to how much the work there is to do around this proposal, and so pleased that you were all able to join us and spend time and sort of share with the listeners today. Pedro, did you want to say a few closing words? Thank you from me to all of you.
Indeed, just to thank you, Susan, and the participants. This was an extremely interesting debate. We could have stayed for much longer, but maybe we'll continue next time on the 31st of March for our second joint webinar on the consolidated and market data. For closing, I want to remind participants that the recording of this event and the slide deck will be uploaded to our respective websites so that everyone can have access to what we have just discussed. And with that, I wanted to thank everyone for their participation and wish you all a fantastic end of the week. Many thanks.